Hi everyone, welcome to the latest TM Brunsdon market update. I hope that you're all keeping safe and well during these very strange times. I'm pleased to have with me this morning Mark Shields, Investment Manager from Macdonald, who will be answering a few topical questions. Welcome, Mark.
Morning, Brian. Morning, everyone.
Good morning. Markets have picked up somewhat of late, and I'd just like to run through a few questions our clients are asking at this moment in time, Mark. First one off the bat is, what are your thoughts with regard to the outcome of the US election?
Yeah, absolutely. It's a good question, and obviously it's quite a significant event that has moved markets over the past couple of weeks. The US election was very much one of the main sort of risks that investors were concerned about. And in the event, actually, the outcome we think was reasonably positive. We didn't see a Democrat clean sweep, so we didn't see them gain control of the Senate, for example. But Joe Biden has almost certainly won the presidency, and the Democrats have retained control of Congress. In some ways, this is possibly one of the better outcomes we could have expected. It means that essentially some of the turmoil that was instigated by the Trump administration will be diminished, but also some of the more extreme policies that may have come about from a Democrat clean sweep, the risks of those could well be diminished, such as significant corporate tax rises. So in lots of ways, the outcome has been very positive for markets, and indeed that was reflected in asset performance in the aftermath of the election itself. The only thing that we need to keep an eye on is the fact that there are two more seats in the Senate up for grabs in Georgia, with an election scheduled for those on the 5th of January. So if the Democrats do win both of those, then the Senate will be tied 50-50 between the Republicans and the Democrats, with the Vice President Kamala Harris having a deciding vote. So essentially, the Democrats would then regain control of the Senate as well, with all three main bodies of government within the US under their control. That's unlikely to happen, but it's something that we're watching out for. And I think the key point really so far is the fact that despite what Trump has said through various mediums, the civil unrest, the legal processes have, generally speaking, failed to materialize. And although he is holding up the new administration coming in, we don't necessarily think that will be a long-term issue for markets. And indeed, as I said, it's been reflected by very positive performance in the aftermath of the election.
Okay, so reasonably positive at this moment in time. Mark, let's move on to the COVID situation. Obviously, there are lots of developments here with regard to the vaccine. How do you see this impacting markets and portfolios?
Yeah, again, a very, very recent and interesting development. Clearly, another one of the big risks that investors have been very focused on has been the COVID situation. Again, a few weeks ago, we saw far more stringent lockdown measures being enacted across many European countries, including the UK, with a lot of concern regarding the second wave that has developed. Then around about a week ago, Pfizer and a German company called BioNTech announced that they had carried out an extensive study on their vaccine, and it showed a 90% efficacy rate, which is much higher than many people expected, and markets reacted very positively accordingly. Actually, subsequent to that, only in the past couple of days, we've seen another vaccine trial show even higher efficacy rates, or supposed efficacy rates of 94%, which has been a vaccine trialed by a company called Moderna in the US. So the take home really has been the fact that these vaccines are on their way. Questions do remain as to clearly whether these figures are as good as they claim, and also when is realistic for them to actually be made available to the wider public, but it has led to a significant shift in markets. What we were seeing prior to the release of these vaccines was growth sectors such as technology, consumer discretionaries, consumer services, healthcare. These parts of the investment universe were all performing exceptionally well because investors were anticipating a further period of low growth, low returns, and these high earning companies were expected to be the companies that will continue to deliver the growth that investors would require in that sort of environment. When these vaccines were announced, we saw an extremely rapid shift away from those sort of companies into parts of the investment universe that had massively lagged, otherwise known as cyclical companies. So I'm talking about energy, financials, property, industrials, all of the sort of parts of the investment universe that had really suffered prior to the announcement of the vaccines, then promptly picked up again. This is because investors suddenly think that actually these parts of the economy, or global economies that really had been beaten up badly, now actually have the prospect in a quicker return to a more normalized environment, have the prospect to really perform exceptionally well. And this actually had a fairly beneficial impact on our portfolios because we have some funds or assets in both the cautious fund and the adventurous growth fund that are quite concentrated on these sort of cyclical companies. It's a technique known as value investing, and those funds performed exceptionally well off the back of this rotation into those sort of unloved names. So again, that's something that we see that panning out as part of a new longer term trend. We expect that to be quite beneficial to those sort of assets in the portfolios.
Okay, so once again, largely positive. The big question, of course, will be the timescale involved.
Absolutely, and that is the thing that I think is one of the big questions at the moment, and we'll have to see how that pans out.
Yeah, indeed. Okay, Mark, last question for today is, where do you see the key short-term risks that markets are facing at this moment in time?
Yeah, I absolutely. Despite we've sort of already mentioned one really. Despite the very positive news with regard to the vaccines, we still think that in the near term, COVID numbers pose a potential risk. It may well be that if we don't see the current lockdown measures being effective enough, that governments may possibly be forced to carry out more stringent measures until the vaccines are actually released themselves. There's a counter argument to that, of course, which is that maybe that with vaccines on the horizons, governments would be more prepared to let things run for a little bit longer as they are. But that certainly remains a risk, and obviously the risk of the actual vaccine themselves, if the data doesn't stack up to what it's claimed to be, is now posing a significant market risk as well. So we need to be aware of the fact that situation has not gone away. The other near-term risk, very much for the UK and European-based investor, is the Brexit risk. We continue to await any concrete news as to what is going to be happening with regard to a trade deal between the UK and the Eurozone. Our expectation for a light deal of some description, which would probably only really cover goods, not so much on the services side, which wouldn't necessarily be terribly beneficial for the UK. It would probably be more beneficial for the EU. But that is what we're sort of expecting at this point in time. Essentially, we think that Johnson needs a win, and this is possibly one way in which he can show progress rather than a constant stream of U-turns and, frankly, government issues that we've seen over the past few months. But this risk still remains that we don't see that at all, and we see a no deal outcome, and that could well have a significant impact on areas such as UK companies, especially those domestic UK companies, which have performed fairly well recently, but also sterling as well. We would expect to weaken quite significantly on the back of that, as sterling has largely priced in a light deal of some description. The other risk that we may well face is a very short-term political risk from the US. As I said earlier on, Trump is refusing, so far at least, to go gracefully into the night, as it were, and hand over the reins of power in an ordered fashion. And he may lash out in one form or another. He's already started to do some very localized sort of recriminations against individuals in the US who he felt weren't supportive enough of him in the election, and he started to fire some of those people. There is a concern that he may be a little bit more extreme than that, and lash out globally against some nation, Iran being the obvious one, which again could well cause geopolitical tensions to spike in the near term. And again, we may have to be cognizant of those short-term risks until he is out of the White House, I believe, on the 20th of January. Having said all of that, those are all very short-term risks. Our longer-term view remains one of quite a positive situation. We think the economic data, especially from parts of the world such as China and the Far East and emerging markets, remains very positive. Economic data from the US has been picking up and is looking a little bit better. A lot of the money that cash that is sitting in money market funds, especially in the US, started to come back into equity and higher risk markets, and that's a trend that we expect to continue to drive market performance going forward. So we think that over the longer term, despite some of these short-term risks I'm mentioning at the moment, we continue to believe that risk assets are looking quite well placed to deliver above inflation returns over the longer term.
Okay, thank you, Mark. That was a good, comprehensive overview of things, and in the main, positive outlook, which is good. So, Mark, I'd like to thank you very much for your input today, and I'd like to thank you very much for watching. As always, if you have any questions, then please be in touch with us. Thank you.